The tax planning area and the tax compliance area is an area that CPAs have a natural background in. We've got the expertise there, and a lot of the CPAs that have moved into financial planning have evolved there from a tax practice. Integrating tax planning in with financial planning, and especially retirement planning, has become critical. I think even more so since ATRA in 2012, with higher tax rates on investment income and other sorts of income, ordinary income as well. I think that the CPA, this is one of the reasons the CPA is so well positioned to help in the financial planning area. But I want to talk a little bit about how that comes into play here. One of the issues I think we see is asset location. Where should you have certain types of assets in the portfolio as you move towards accumulating assets in retirement? David, some thoughts on that?
Yeah, asset location I think is an area where you can add a ton of value, and the studies that have been done on it shows that it's potentially enough to even cover a lot of our fees. And so it is big, and being a CPA, it carries a lot more credibility, and you can probably execute it a lot better than perhaps other advisors out there. And when you think about it, there's really three buckets of your investments. You've got your taxable investments, your tax-deferred investments, and your tax-free investments. Those tax-free would be Roth, the tax-deferred being kind of your traditional accounts. And this is where you do have to start weighing simplicity versus, whether it's worthwhile or not. The simplest way would be to put in each account, put the exact same asset allocation. It's easy to track, it's easy to see, but doing so means you're probably paying a lot more in taxes than you need to. If you instead match each asset of the whole portfolio and put it in the account, so treat it all as one big integrated portfolio and then match up the tax characteristics, you end up with a much more efficient portfolio. So an example is in the taxable one. There you want asset classes that have a high expected return but are very, very tax efficient. So that's stocks that you're going to hold indefinitely, those kind of types of total market, low turnover funds. On the tax-free Roth accounts, you want things that have high expected return but are very tax inefficient. The classic example would be REITs, which have high expected returns over the long run, but pay out almost all of their return as income, and doesn't qualify for qualified treatment. And lastly, fixed income would ideally go in a tax-deferred account. It's very tax inefficient, but it's also lower returning. So by putting that in there, you defer all that income that's when it's coming out, it's going to be taxed at ordinary income rates anyway. And the byproduct of that is also going to reduce your RMDs going forward for that account. So by doing that, I think a lot of the studies are showing it's about 0.75% in tax savings, an equivalent return. That's significant. That's 3/4 of what most people are charging in fees, and that's not something that a lot of planners are doing right now.
Right. Some real value added there working with clients. What about Roth conversions? You mentioned Roth IRAs. I know we've seen in our practice a lot of clients using Roth conversions during the years before they start drawing money out of their retirement accounts. Ted, do you see that in your practice from a planning standpoint?
I see it more and more, and actually clients are pretty sophisticated these days that they're actually bringing it up themselves. And they're saying, should I be doing these Roth conversions that I'm reading about? And Bob Keebler talks about a 15-year tax projection. And Michael Kitts has made a comment about a engineer client that was so proud that he got to got to 70 and a half and said, I had no tax until I had to start taking my RMDs. He said, well, you blew it. you had 11 years where you could take money out of those taxable accounts, pay at 15% or at
or
most
lower,
25
zero,
or maybe zero, and not pay any tax on these things until then. So the idea of that Roth conversion, I think, is becoming more popular as more is written about it, and people are considering that. And I think it's a very good idea for those clients between 59 and a half and 70 and a half when you must start taking out of those plans.
Yeah, you don't want to give up the opportunity of those low tax bracket years and take advantage of those. And Roth conversions are great because you've got 20/20 hindsight. You do the conversion, over-convert in the year you do it, and then you've got until the extended due date of the return to come back and change it, to characterize it. So there's not too many opportunities that you have like that from a tax planning standpoint.
Right, and with a lot of clients deferring their Social Security to 70 but stopping working before that, you get a few gap years in there that are great opportunities to do those Roth conversions.